Hi everyone, it's Serena here from Sentiment. Thanks for joining us. In a moment, I will introduce our guests from 1inch Exchange, but before we get into the interview and their announcements, please help us get the word out by subscribing to our channel and hitting the like button. Today, we are excited to have the CTO and their smart contract developer of 1inch Exchange join us on the channel. It's certainly been a hectic time for 1inch, and they're here especially to fill us in on what they've been building. Welcome, Anton Bukov and Mikhail Melnik.
Hi.
Broadly speaking, what's your current perspective on the crypto markets? If you could give us like a quick update on what you've been seeing.
Yeah. Okay. We started 1inch in May of previous year. So since that time, we achieved like $1 billion in volume in total. It was in previous month, but like DeFi and DEX market exploded in this in latest month, and right now we have like speed 1 billion per month. Yeah.
Actually, the growth is exponential.
Yeah. Our exponential growth started like in October or in November of previous year, and each month we doubled total volume, and like in each month we had half of total volume, and it like had like exponent was like finished in March, and for 2 months volume was much lower after Black Thursday. Maybe you remember it, when most of cryptocurrencies dropped significantly, and then in June and July we returned on exponential scale. We did like 300 millions in June with more than $500 million in total, and we did 600 millions in July with more than 1 billion in total. So right now our speed is that we're gonna make 1 billion in 1 month.
Thank you. Mikhail, do you have anything you'd like to add?
Well, I agree with Anton that actually 1inch is increasing volume represent overall market growth, and that for me, I think it the whole market grows right now exponentially, and we just keep up with that.
For members of our community who might not already know about 1inch Exchange, how does 1inch Exchange work, and briefly what goes on in the background and the back end?
Okay, I can describe you shortly, and hope Mikhail will describe like potential opportunities to also improve even existing algorithm. So when we started 1 year ago, whole the idea behind was just distribute your volume among multiple dexes. So when you swap on each dex, the more you swap, the worse will be the rate. This is not surprise to anyone, because this depends on supply and demand on both sides. And when you distribute your volume, you swap less on each dex, and price impact will be less. So you could achieve better rate than on any other dex by just splitting among the dexes. And 1inch proposed to make this with one single transaction. So we send user funds with additional instructions to our own smart contract. This smart contract uses these instructions to perform multiple trades, and then check that result is enough for the user. It's like it fits. It is greater than mean possible return, and if it's okay, the result is returned to the user. But if it's less, then we just revert all the transaction, and so it's like all or nothing. And users can set up like max possible slippage. Sometimes they set 0.5%, sometimes it's 1%. It depends on how fast market moves on for the contract pair. You know, if it's some highly volatile token which just started, even few percents of max possible slippage can help if price can grow for a few percents in few minutes. Yeah, so when we started, things were quite simple. It was aggregation among 3, 4, 5 sources. We also built like a very first prototype right on the hackathon as New York, and we had aggregation among Uniswap, Kyber, and Banker. The DEXs were like aggregated, and in few months we added most of other DEXs. But since 1 year passed, things changed significantly. Right now, if you just want to swap two tokens, it's like selling either for DAI or buying either for USDC. We have to check hundreds of different sources for the user, because all these pool protocols like Balancer, Uniswap, and new version of Uniswap, and many other things like token set and others, they allow users to create a huge amount of pools, where each pools behave as a separate DEX. So right now it's not just about distribution among sources; it's about building more interesting paths. Maybe Mikhail, you want to add something about?
Yeah,
this?
actually, what Anton is talking about is that with the release of Balancer protocol, the things started to be really complicated, because the liquidity now is split among hundreds of different sources, and even if you want to just make a simple split, you now have a choice of like dozens of similar liquidity pools that have those two tokens, like ETH and DAI, for example, that Anton was talking about. And now we want to move the things to another level. And for example, in the swap from ETH to DAI, what we can do is we can swap half of that directly from ETH to DAI and half of that to USDC, for example. And then we can swap the remaining from USDC to DAI on Curve. And stuff like that is much more complicated than simple split, because now you have some second order effects, because when you do a multi step, like when you swap into the one asset and then into the second asset, you need to take into account the changes that were introduced on your first step. So what we are doing right now, we try to implement an algorithm that will work, on all the existing pairs, that will find all the paths through all the possible liquidity sources. And the common theme between those paths are that they start from the token that user specified and finished in the token that user specified, but they can go through any other token in the middle. And this is kind of like, this is complicated, and this is what we are working right now to deliver.
Okay, cool. Well, I guess this kind of leads into the Pathfinder algorithm. Could you speak a little bit about that? Yeah.
So basically, what I just described is what we call Pathfinder. We have a simple implementation of that right now, working in production, and it is simple because it doesn't combine all the passes. So it just finds one pass that consists of multiple hops. So that one that I talked about, like to swap from ETH to USDC and then to DAI, this is an example of that pass. And we introduced it mostly for some not super liquid tokens that can have a lot of liquidity, not on the direct pair, but on a pair that connected through another token to what user want to swap. And on that tokens, our current Pathfinder implementation works very well. So it finds it often finds the path that is like provides you with 20, 30, or even 50% more tokens as a result. So, and what we are working right now is Pathfinder, the next version of Pathfinder that will combine all those passes and will optimally split between them. So something like that.
Perfect.
The things became even more complicated because we have to take gas costs into account, because all these protocols have different gas costs, and it became even more harder.
Yeah, predicting gas costs is like another different problem that we have to solve, and it is not super obvious how to do that, because even different ERC20s have different gas estimations on just simple transfer. So for example, compounded tokens, they do a lot of stuff under the hood when you do a simple transfer, and it costs a lot more than just transfer DAI, for example. So we also work on that to optimize efficiently gas costs. Yeah.
What is the Chi token, and will there ever be Chi 2.0 or staking?
I can start, maybe Mikhail will add. So like a few years ago, gas token was introduced by some guys from New York who also speak a little bit Russian. We talked to them on DEF CON, which was in Osaka previous year. And the whole idea of the gas token is to exploit EVM feature of gas refund. So when you write something to storage, it's like can be adding some records to the smart contract or creating some new contracts. This costs you a lot of gas. But if you're gonna erase old records or destruct old smart contracts, you will be refunded for this. Because if you will not have any refund, there is no reason to spend additional gas on erasing storage at all. No one would erase storage if it would cost additional money and would not return something to you. So gas refund was introduced, and for example, when you erase, like when you write to storage, new record could cost you 20K of gas. But if you would erase it, this would cost you 5K of gas, but will give you 15K of gas refund, which will be applied at the end of the transaction. But the total gas refund can be bigger than half of gas used by the transaction. So, and it's almost the same for the creating smart contracts. New smart contract would cost you 32K of gas plus additional cost for the size of smart contract, and gas refund for destructing smart contract would give you 24K of gas. So there were two versions of gas token initially, GST1 and GST2. They were built on different approaches. First one was built on top of storage of single smart contract. Second version was built on having smart contract, which creates a lot of sub smart contracts and destructs them when need to burn. And we also created our version of second version of gas token to have, which have sub smart contracts, since it's more efficient. But we added usage of create2 instead of create. This is like different version of creating smart contracts, which like gives us more predictable way to discover these smart contracts after creation. You know, since this gas token do not store all the addresses of sub smart contracts, it can just compute them with just a hash computation. It's quite cheap. So we created new version of gas token, which we call Chi token. It's like few percent more efficient comparing to GST, and possibly eventually we would have a next version if we would find like significant improvements. We found some, but they're not yet significant. Mikhail, want to add something?
So, yeah, so basically the most like the area of the improvement here is the size of bytecode that we store when we create those sub-smart contract. And like the simple optimization that we also had in Chi is just the address of the GST2 and the Chi token. If you look at the addresses, they start with zeros, with some zeros. And the more zeros, like the more leading zeros you have in the address of smart token, the more efficient deploys you have. So the minting of those tokens is more efficient, and therefore you can spend less gas on minting, and you will save some more money. And this is the main vector of improvement. And like the simple approach is to increase the length of leading zeros, but it costs a lot of money. So we did some calculations on how much money it would cost us, and decided that we not yet kind of ready to spend that amount of money to pre-compute such big amount of leading zeros. So we left that to another version. And well, there are also maybe some hacks that allow you to decrease gas cost of minting, but we didn't come up with them yet. So yeah, this is something that we might do in the future. But the overall, the overall increase in gas efficiency would be again like 1-3%. So it is very limited increase in efficiency.
Yeah, it seems I forgot like shortly describe how users can use it, because it's quite simple. You can mint it anytime. Anyone can mint any amount, but minting would cost you a lot. Minting one gas token would cost you at least 34 possibly K of gas. Mikhail, am I right?
I don't remember exactly.
Yeah, it's nearly to maybe 35K of gas. So you can mint any amount. Anyone can mint any amount. This Chi token is not like token of 1inch project. It's like highly utility token on this gas refund feature of EVM, and no one is owner of this token. So we know some guys who mint a lot, who own a lot. They mint, sell it. They mint when gas prices are low. They sell when gas prices are high. And yeah, you can like think of it that price of Chi token highly depends on gas price in Ethereum network. So right now I see gas prices are nearly to 100 UAs. And if price will be 200 UAs, it's highly possible that Chi token cost will be twice bigger. But this depends on how much it costs right now, because current cost could be equivalent to minting it on 100 UAs or 150 UAs or even 200 UAs. So it may be non-profitable to print it right now, but it's cheaper to buy it, or opposite, or inverse. And so as I remember, it will be profitable to mint it at some gas price and burn it when gas price is at least twice higher. Am I right, Mikhail?
Yeah, basically yes.
Yeah. So if you can mint it, for example, at 66 UA, right now safe low is 66, and if you would spend it when gas price is higher than 140, 150, you will get benefit of it. Yeah. Or you can buy it. If you can buy it cheaper than minting it at this gas price, so it will be profitable for you. Yeah. So it depends on the situation, or what money you spend on buying or minting, and yeah, when you will burn it. So any project can integrate it to allow user to burn its own token from own wallet at the end of the transaction. So like we integrated in 1inch or 1split, which is basically our on-chain version of 1inch. Anyone can integrate it, and I heard some projects are working on it, so it's not quite difficult. The users have to just add a proof of chi token to their smart contract, and then these smart contracts at the end of the user transaction will be able to burn from user wallet, burn chi token from user wallet to provide some gas refund. So user will see that his transaction possibly cost 2 million of gas, and after burning like few dozens of chi token, his transaction cost will be a little bit more because of calling these burnings. Like one burning would cost you 6K of gas, one burning of one token, but it would give you gas refund 24, so you have difference 18K of gas. So if you have like 2 million gas transaction and you have option to burn, possibly you would pay 2,200,000, but this would be gas limit, but actual gas used after burning would be decreased to possibly 1.3 million. So instead of paying for 2 million, you would set gas limit 2.2, and the transaction would cost you like 1.3, and also the tokens you burned you will lose from your wallet. Yeah, that's how it works.
Also, I think we can add that we deployed some interesting smart contracts that help developers to do their stuff. For example, we have deployed a deployer smart contract, which is also support chi burning, and anyone can use that. It is available at the ENS address deployer.eth. And how you can use it just to deploy your smart contracts. So if you want to deploy your smart contracts and you want to decrease your gas costs, so you can utilize the deployer smart contract, which will burn chi tokens after you deploy.
So cool. We'll place that in the notes below as well. Something we haven't talked about, and it's super exciting, is Mooniswap. How is this different from existing automated market makers, or AMMs? And yeah, what can you tell us about Mooniswap?
Okay, I'll start, and Mikhail will add. Okay, so we spent many months thinking on how we can improve AMMs, existing AMMs. AMM is automated market maker. This is usually smart contract which can own some assets and provide liquidity for exchanging these assets one to another. And people always allow it, usually people allow it to deposit to this smart contract and withdraw it. And they can do this usually at any point of time. And this AMM tries to earn for them. So you can deposit pair of tokens, and after 1 month withdraw them, but you can earn on this, but not it's not like necessary. I mean, hope Mikhail will add about this.
Yeah, what Anton is trying to say that when you provide liquidity to most of the automated market makers, you hope to earn on fees. So they all have some fees integrated, and you as a liquidity provider, you will earn the portion of that fee that is proportional to your to the liquidity that you provide. And but this is not riskless, as you can like when you put your liquidity into automated market maker, you basically open it to the risk of price changes, and those price changes between those two assets that you provided can cause you a loss because because of the way the automated market makers works. We in the industry, it is called impermanent loss because it is only dependent on the price. So if the prices go they diverge a lot, so you will lose a little bit money. But when they come back to the point where they were at the start, your impermanent loss will disappear and that's because that's the reason why people call it impermanent. So what you hope is at the end of the day, when you will remove your liquidity, you hope that fees that are accumulated on that liquidity provide on that AMM are higher than impermanent loss that you get. So if that's true, then you will earn some money. If that's false, you will lose some money. And so based on that, Curve, for example, tried to solve that problem. They just put two assets that cost the same, like one kind of dollars and another kind of dollars. So they don't diverge too much. So you essentially don't have impermanent loss and you just earn on fees. Yeah. So but that's how most of the AMMs works. And what we tried to do, like we saw two another problems in automated market making. Like the first problem is front running. So basically, when you want to make a transaction that swap some assets on the market on automated market maker, some front runner may come. Like when you form a transaction, what you have is like, I want to swap this amount of tokens to this amount of tokens, and like the market rate will give you, for example, like 100 amount of tokens B, and you say, okay, I allow this transaction to happen if the market maker will give me not less than 98, for example, 98 tokens B. So, and if the current rate is will give you 100 tokens B, then frontrunner can come and swap before you to make your transaction give you 2 tokens less, but your transaction will still process. And then right after your transaction, he will swap back and earn like some percentage of the trade. So this is what is called front running. And another problem is that automated market makers, they need arbitrators to work correctly for price discovery. So the market itself doesn't know about the real price, like the real market price. So the one way is to use Oracle for the price for that price discovery, and another way, like what is Uniswap and markets that are Uniswap like utilize, is arbitrators. And those arbitrators just swap between different decentralized exchanges, or even decentralized and centralized, to make prices equal on different exchanges. Because if there is one DEX on which price is higher than another DEX, you can buy here cheap and sell on another DEX with a profit. So the problem is when you come to decentralized exchange and swap a huge amount of money, right after your trade, the arbitrators come and swaps all that you bring into the DEX back. So like it can happen in the consequent transactions, like in the same block, one transaction is your transaction that swaps a huge amount of money, and right after your transaction, there is an arbitrator that swaps back. And if you have fixed fee, like on Uniswap, the profit of that arbitrator is enormous. So he basically takes all the slippage that you put into the pool, and he takes all the slippage back to his profits. And we thought that we can fix that. So what we introduced in Mooniswap is a delay between. So now in Uniswap we have two prices: the price for buying and the price for selling, and they are based on virtual balances. So we inside the Mooniswap we have balances that are calculated for the sell price and balances that are used to calculate the buy price. And when someone buys and does a huge trade, his slippage, that like the price movement that is caused by his trade, it is not immediately available for arbitrators, but instead it is linearly, like slowly moves on the interval, on the period of 5 minutes. It slowly moves from the price that was before the trade to the price that became after the trade. And what it leads to is that, like, at some point between those two prices, arbitrageurs will come and take the trade back. Like at some point, that trade for arbitrageurs will become possible, will become profitable. I mean, so when they come in the middle of that line, like between those 2 points, they come and swap back. All the slippage that is not that is not yet available for arbitrage will be saved in the pool. So basically, what we did is just utilize those arbitrage trades to save more money in the pool. So when traders come and trade with a huge slippage or with a little slippage or like whatever, when arbitrage happens and arbitrageurs trade back, we save some portion of that slippage in the pool, and that will probably allow liquidity providers to earn much more on their provided liquidity than just a simple fixed fee.
Yeah, we also computed some statistics about slippages on Uniswap. So we saw on like most of the pools, slippages were like twice bigger than actual fixed fees, and we like did some prediction that possibly up to half of the slippages could be potentially earnings of arbitrage traders. And on some pools, these slippages were 7 times bigger than earnings of liquidity providers on fixed fees. So we came up that this is a huge problem when user, like it's rephrasing of what Mikhail said. When some user have like swap, it have like fixed fee introduced by AMM like Uniswap 0.3 and slippage fee, which is introduced by amount he swap, which amount he swaps. The more you swap, the worse will be the rate, and this called like slippage. And all this, the significant part, most part of this slippage fee could be immediately earned by arbitrage traders. When you lose few $100 on this, swapping few $100,000, arbitrage the fastest arbitrage traders comes and gets immediately this few $100. And arbitrage traders also pays a lot to miners. They said super huge gas fees to be the first one who earn this. And we came up that we could improve this by not introducing arbitrageable price immediately. So if you have like $1,000 slippage on Uniswap or on AMM, and you traded few $100,000 possibly, on regular AMM of all other implementations like Uniswap, Balancer, Banker, arbitrage trader is able to capture $1,000 in this exact block right now. The fastest arbitrage trader will earn this. And we came up that we could potentially solve it by slowly improve price for opposite trade instead of providing immediately a super cool price. And when price became cool enough for arbitrage, arbitrageurs can wait for 5 minutes and earn $1,000. But they can't wait because it's highly competitive for them. And if they are not gonna earn these few bucks, someone else will earn. And this would allow pool to capture slippage which happened previously.
Oh, so interesting.
I can share screen with our on-chain statistics if you wish. It's,
yeah, sure.
It's built with Dune Analytics. It's Dune Analytics dashboard. The coolest part of this dashboard is that you can fork it, you can inspect every query of it, so anyone can do the same for any other project. It's not super hard to copy all this stuff, but you still have to be a developer with understanding of SQL queries. So as you see, our total volume is more than 1.6 billions, and our current speed is like $250 million in 1 week. And we see that you can see like 3 types of charts. In the left column is like daily volume, users, transactions, and in the middle column is weekly, and in the right column is monthly volumes, users. We have also some predictions. As you may see, on the current month, we already passed 372 millions on 1inch, 82 millions on one split. One split is fully on-chain version of 1inch, and some of our clients are interested in integrating this kind of stuff. And we also have prediction. It's 400 millions more volume for both sources. It's like linear extrapolation. As like today is 17th of August, if speed will be like the same, at the end of the month, we will have 400 more millions in volume. And as you may see, we have like a little bit less than 1,000 users per day, those ones who make transactions. You may see that we have more than 2,000 transactions every day. And one of the coolest charts are here. It's user distribution among their total volume. So you may see the most significant cluster is 1,781 users who swapped in total from 1,000 to 2,000 bucks. And each next bar is twice bigger. So it's exponential scale. So the top 3 persons swapped from 16 millions to 32 millions. And yeah, it looks like normal distribution, but on exponential scale. And also we have almost the same chart, but not for the users, but for the trades. So if you wanna know how much is it like average trade, you may find that the most trades were from 500 bucks to 1,000 bucks. It's almost 30,000 trades. Yeah. And we can see the biggest ones. 2 trades were from 8 millions to 16 millions. So the range is quite huge because each next bar is twice bigger. If it would not be exponential, it would be like huge area with small bars. So we decided to make it exponential. And on this dashboard, we also have overall top trader statistics and 24 hours top traders. So anyone can check his wallet to understand how much volume he produced through 1inch.
Nice. Well, we're certainly taking a deep dive straight into these stats. Okay. So I guess the next part of what I want to understand is in decentralized finance and DeFi. How has, I guess, the landscape of DeFi affected the recognition of 1inch exchange?
Yeah, no, when we started, it was like a DEX aggregation. But the more we inspected like DeFi, we found different protocols, different products, which can be integrated directly into 1inch, but it's not about DEXs. Like, you can easily wrap your DAI into a DAI or C DAI, it's Aave or Compound, on 1inch. So it looks like a swap. You can swap DAI to C DAI, but we have Compound native integration, so we will not like swap you on Uniswap because you will have slippage. We can use this direct implementation to provide you slippage-less swap. It's like native wrapping. But when you swap few bucks, it makes more sense to swap on Uniswap because wrapping into Compound could cost you like few 100,000 of gas. But swapping on Uniswap is usually less than 100,000 of bags of gas. Sure. So it depends, and we integrated most of this tokenized version of different DeFi protocols. If some protocol is tokenized, we integrated it and allow it to swap on it. And we see like a huge simplification for the users, because before we integrated all this, users who used to use Compound, Aave, and many other things, they were used to use different websites, check them, and they have like different interface on every website, and it's quite difficult to like have deals with 3, 4, 5 different products. But most of the people who like discovered 1inch, they were like very happy that they can just swap. It's like simple interface. They have DAI and want a compound DAI. It's so simple, and we like produced Kayak-like interface. It's called Kayak-like because possibly Kayak was the first site who introduced like source and destination and one button. It was a air ticket website, and it's called Kayak-like interface. So people really like this, especially that we can provide these native integrations of all these protocols. When you have like a more complex swap, you can swap Ether to CDAI, and it will convert your Ether to DAI, and then will wrap it into CDAI. So people really use it because on Compound website, you will not be able to swap Ether to DAI and then put it into CDAI. You will have to use few products, one for swap, one for wrapping, and it's not really convenient for most of the people. They can do it like with one single transaction. It would even cost you less because it's a single transaction. Yeah.
Okay, and I guess on that note, what are the most popular pairings that are traded on 1inch?
I believe the most popular trades are still trades of Ether with stable tokens, but we also see huge interest between stable tokens. The most liquid DEX for these pairs for stable tokens is of course Curve, and we also like allow people to split among multiple Curve pools, and Curve website also integrates our on-chain version of algorithm, which is called OneSplit, our latest version called OneProto, and our next version, which we're gonna release really soon, will be called like 1inch router, possibly, and it will be even better. It will give much better results. So it's quite easy to integrate our smart contract into website, and it will behave in permissionless manner because you can use like 1inch API. It will give you like much better prices, but because it will also aggregate off-chain resources. But if you just want to have no dependencies, you can just utilize 1inch on-chain protocol. It's just smart contract. You can ask smart contract, give me like a best price and distribution among all these protocols. I want to swap something to something, and it will give you instructions, and you can tell this smart contract, okay, then swap with these instructions, and it will do this for you, and you will not just interact with any other API. It's just smart contract and your Ethereum node. And projects like Curve integrated us because they really like the idea of splitting among their pools. They have like interface for swapping, and they allow you to select any pool. You can swap on this pool or on this pool, but splitting among pools, even taking gas fees into account, is not that easy. And like we have it, and they can use our fully on-chain solution with special flags, which captures only Curve pools, and they have like integrated on front end, and it's quite easy, you know. Yeah.
I'm certainly excited to see future integrations of 1inch. And yeah, just finally, congratulations on your impressive funding round led by Binance Labs. Would you like to talk about the possibility of future investment rounds?
We right now we're in the progress of our round A, because we found out that a lot of huge and well-known, wide popular funds wish to get in, but they were not able because our round was pretty tight for them, and they have like checks which is like bigger than all our round was, and we right now talking to all of them and looking for a way to make this happen in possibly this month, because we don't want to spend a lot of time for this, because our first round took few months and it was really exhausting for us to do this round and work on all our products. And yeah, we prefer to build products, not to spend much time on round. Yeah, so if someone is interested, they could ping our BizDev or Sergey about the details, and they will provide. Yeah, but we hope to finish in this month, but it would take a few more weeks. Yeah, but I believe that we will not spend our own time on this because we're gonna to build a lot in upcoming weeks and months.
That's good to hear. The project is focused on the development and the building and not in other areas. Thank you so much, Anton and Mikhail. We've taken up some of your valuable time, and also to 1inch Exchange. I'll be sure to leave some contact details to you and 1inch in our show notes below. And if we've missed anything in this interview, we'll be sure to go ahead and reply to your comments below as well. So thank you for tuning in, and see you on Friday for our regular show, This Week in Crypto.